No matter how much we fight with our family members, at the end of the day, we sure love them. She'll help me in many situations, like being the best wing woman ever, helping hide some questionable stuff from my parents, and much more. But did you know, family can not only save you from your niba-nibi problems, they can also save you from a lot of money problems.
But why involve family in business? It's a recipe for disaster. Because only 21% of women work in India. And what does it imply? Most families depend on a single breadwinner. If that is the case, a family collectively needs to utilize all the possible ways to save more money. Now, even if both Niba and Nibi are earning, there are some tax saving hacks that can help you save money in the long run.
That is why you need to watch this video where we talk about how to plan your finances in collaboration with your family members, irrespective of whether you like them or not. Throughout our lives, our parents help us in so many ways that cannot be put into words. And surprise, surprise, there's one more way they can. Senior citizens and super senior citizens have a basic exemption limit of 3 lakhs and 5 lakhs respectively. And you have a basic exemption limit of 2.5 lakhs only. So if you combine the tax liability for both, you and your parent can substantially reduce the taxable income if you plan properly. Yeah, don't make those confused faces. Of course, I'm going to explain the concept to you with the detailed example. But before that, let's first understand that senior citizens have other tax benefits too. Section 80 TTB is specifically made for senior citizens. Under this section, they can get a deduction of up to 50,000 rupees for interest earned on savings and deposit accounts in their name, like savings account and deposit accounts with banks, cooperative societies, or post offices. Also, banks provide 0.5% more interest if the depositor is a senior citizen. Now, assuming that you're the rich guy in the 30% tax slab, just like me, and your parents are nowhere near the same tax bracket as you are, you can simply start investing in their name instead of yours. So in this way, the interest will be accumulated in their name, not yours, and you won't have to pay the taxes at a whopping 30% slab rate on the same. Here's the table for you to understand better. Here's the simple math. You have 10 lakh rupees, you can invest them in your name or your mother's or your father's name. FD rate of interest is 6% for you, but it is 6.5% for senior citizens and super senior citizens. So while you get only 60,000 rupees as interest income, your parents get 65,000 rupees. Taxation wise, at 30% tax bracket, your taxes are at a whopping 18,000 rupees. For them, even they have the same income, they fall under the 5% bracket and taxes are only 750 rupees. That's like a pizza's price. So as a family, you just saved 17,250 rupees. Now you can buy those new Nike sneakers that you were eyeing. But wait, there's more. If you buy a health insurance cover for them, you can get additional tax benefits. For example, if you pay for their health insurance premium, Section 80D provides for a deduction of 25,000 rupees and 50,000 rupees for your parents who are aged below 60 and above 60 respectively.
एक स्कीम है, अमीरों की स्कीम मेरे हाथ लगी है.
For example, suppose both of them are senior citizens and their combined premium is 43,000 rupees which you paid from your own pocket. Now since this is within the 50,000 rupees limit, you can claim that entire 43,000 rupees as a deduction while filing your taxes. Also, according to Section 80 DDB, medical expenses incurred up to rupees 1 lakh for the treatment of a senior citizen parent or up to 40,000 rupees if the parents are aged below 60 for specified illnesses are tax deductible. So if your parents are dependent on you and are suffering from some chronic illnesses specified in the law such as dementia, cancer and Parkinson's disease, try to get a certificate from that treating doctor explaining the severity of the illness. Apart from your parents, you can also use this section in case of a dependent sibling, spouse or child. Now let's talk about HRA. Now even though you stay with your parents, there is a secret hack where you can save taxes on that. Many of you may be aware of the fact that you can pay rent to your parents if you stay in their home while working and claim that HRA. But that rent is still taxable in their hands. Now they can use section 24 to claim a deduction of 30% of their annual rental income as repair and maintenance expenses. So basically, you save money using HRA allowance. They get rental income, but in most cases, they would fall under the lower tax bracket than you, probably 5% or 10% or 20%. So they pay lesser taxes on this rental income. All of this will combine save you a lot of money. But Sharan, I'm not a salaried person. I'm a freelancer.
And how can you become a full-time freelancer?
Or a business owner. What should I do? Don't worry, I got you. There is another area where your parents can save you up to 18,000 rupees a year. Now suppose your family or the HUF of which you're a member does not own any house in your city and you stay at your parents' house, then you can make a rental agreement with your homeowner parent and pay them rent. You can claim this rent as paid as deduction under section 80GG. One caveat though, friends. Suppose you own a residential property anywhere in India. Your income from that property is calculated as per the applicable income tax sections. That means if it is being treated as a self-occupied property for tax purposes, then you can't use the 80GG section. But suppose this is not the case, you're still young and saving up for the down payment of your first home, then living with your parents and claiming 80GG is a great option. Let me illustrate this further with an example. Suppose you're an independent wedding planner. You obviously don't have an opportunity to claim HRA. You earn, say, an average of 36 lakhs per year. After availing business-related expense deductions and other tax benefits, you are left with 9 lakhs of taxable income. Now, if you effectively use section 80GG, your taxable income will further reduce to 8.4 lakhs. As per the existing tax slabs, at 30% rate, you can save 18,000 in taxes. Next is saving money through siblings.
Talking about siblings, if you receive any monetary gifts from your siblings, they are tax exempt for you without any upper threshold. That's why anytime I want something, I just bully him into gifting it to me. In the absence of your parents, if you are acting as a legal guardian to your siblings, you have an opportunity to save taxes. You can claim their education loan tax benefits under section 80E being a co-applicant. Suppose you are the legal guardian for your younger brother. He is very bright and is selected at Columbia University. Being a premier institute, his education will cost lakhs of rupees. He will eventually move abroad, every middle class household dream. Now suppose after the course completion, he is overseas, well placed and happy. He can't take the EL tax benefits because those benefits are provided by the Indian government, not the US. And in India, he has no income from which he can claim this deduction. But you, being a co-applicant in his EL, can pay the EMIs and claim the related tax benefits for 8 years. Now suppose in other case, they are in your hometown pursuing higher studies and you are in Mumbai, for example. If your siblings are dependent upon you financially and travel to your city to meet you, you can use your leave travel allowance to fund their travel as well.
अरे सर क्या बात है?
Also, as we already discussed, benefits under section 80DD and section 80DDB both can be availed for your dependent siblings. Now one more hack. If your siblings are studying, they can avail a student discount at a lot of merchants. So you can ask your college going younger brother or sister to buy such stuff for you. Hey, now go buy me that iPhone, go!
Now that my sister has stopped bullying me, let me tell you about saving money with your nibba or nibby. A house is probably the biggest joint expense we undertake. Getting a joint home loan allows you to get several tax benefits. First of all, benefits under section 80C and section 24B can be utilized by both spouses by contributing towards the EMI. So this way, double tax savings can be achieved from your combined income. Here's the illustration for a house that must be completed within 5 years of loan commencement. But if the home is not completed within 5 years, the section 24B benefit reduces to just 30,000 rupees per annum. So basically, if both Nibba and Nibby pay EMIs jointly, then you guys can claim a combined deduction of around 7 lakhs at 30% tax bracket. This saves you 2.1 lakh in taxes per year. Also, if you are on a budget and are first-time borrowers with a property value of up to 45 lakhs, then you can claim an additional deduction of 1.5 lakh each for the interest paid after fully using the Section 24 deductions. This benefit is available under Section 80EEA. Additionally, women typically get concessional rates on home loans and stamp duty payments. Like in Mumbai, women get around 1% concession on stamp duty payment. One more tip, similar to your own education loan, your NIBI's education loan can also save you money for 8 years if you avail it as a co-applicant. And benefits under Section 80DD and Section 80DDB both can be claimed too, if applicable to your NIBA or NIBI.
Guys, we have seen how costly it is to raise children these days. Wait. I am not against children, but it is good to know what benefits government provides you and to your children. In case of major children who are still learning and have not started earning a sizable income, you can make investments in their name. Since they are broke and won't have much of a tax burden, and since clubbing provisions do not apply, this can ensure a good amount of tax saving. For example, a mother invests rupees 1 lakh in an FD in her daughter's name as a gift. 1 year later, the daughter gets 1,10,000 rupees from this investment. If this money was in the mother's name, she was required to pay taxes on rupees 10,000 earned. But the daughter does not have a sizable other income. Maybe just a paid internship. So rupees 10,000 at her hands do not attract any tax liability. This will help them save up money for their higher education or other expenses. This will also help your child to form a habit to look after their investments properly. You may even ask them to handle petty household expenses like maid, security salaries, food expenses, etc. Additionally, Section 80DD and 80DDB benefits can be claimed as per relevant circumstances for children as well. Now, if you are fed up of your annoying children, send them abroad. This will help you mentally also and financially too. Suppose your child needs an education loan. You can be a co-applicant in her EL. Education loan repayment tax benefits under Section 80E are then available to you also. This arrangement is extremely useful since she won't be having a sizable income from Indian sources to claim a deduction from. Instead, you can claim the deduction and save taxes. I have another lesser known tip for you. If you are falling short to fill up your 1.5 lakh deduction under Section 80C, you can claim money spent on your child's tuition fees. So for example, you have spent rupees 60,000 as tuition fees to your son's college. You have only been able to contribute 1 lakh rupees under 80C investments that year. So out of these 60,000, you can claim a deduction for rupees 50,000. This saves you 15,000 in taxes if you fall in the 30% tax bracket. The deduction is available for any 2 children. So if you need, plan and spend your children's fees after consulting with your spouse. This can help you both optimally utilize the tax provisions.
Now, let us have a look at HUF, that is Hindu Undivided Family. Hindu Undivided Family is a separate tax entity. That means it has a separate PAN card and IT returns that need to be filed separately. This is as if having all the immediate family members under one umbrella, earning together and sharing all the resources. HUF has tax benefits on the notional rent too. So what is notional rent? It is the rent that the government presumes you earn from your property, irrespective of whether you really earn it or not. HUF can own 2 additional properties without considering this notional rent part. It is also eligible to avail home loan and claim tax deductions as per law under Section 80C, 24B, 80D and 80DD, 80DDB and so on for the investments and loans undertaken. HUFs can engage in businesses and spend for its members, get tax benefits. For example, life or health insurance premiums and tuition fees for the members. This means if you form an HUF, tax deductions that you could not have utilized otherwise due to deduction limits given by the income tax department can now be claimed effectively through HUF accounts. For example, let's say you invested in the Public Provident Fund account of rupees 1.5 lakhs for yourself. Now let's say you're also paying for a life insurance premium for your policy, but you cannot get the tax deduction for the second one because the 80C limit is already exhausted. In this case, if you have an HUF account, you can make the life insurance premium payment through that HUF account and claim the 80C deduction under the HUF IT returns. In this way, the HUF can help substantially in tax planning.
Now let me give you a bonus tip. Floater health policies are a great way to save money. Floater policy is the policy where you can include some or all members of your family under a single sum insured. It is useful since probability of all members falling sick at the same time is very less. So all members can utilize a combined sum insured of say rupees 20 lakhs instead of each one taking an individual policy of rupees 10 lakhs. It saves the hassle of maintaining multiple policies, plus they cost similar or even slightly less compared to individual plans. Consider the Care Supreme plan, for example. Individual premiums for a 40 and a 35-year-old couple costs around 11,000 and 9,300 for a 7 lakh plan. A family of 4 with ages 40, 35, 6 and 4 can get the same cover for rupees 20,000. You can then move on to buy a super topper family floater 2 to enhance the sum insured even further. This obviously proves to be very cost effective. Also, in case you exhaust your ATD limit of 25,000 rupees while purchasing a plan for all 4 of you, it may help to split the single floater policy into 2 floater policies, covering 1 adult plus 1 child each. That way, both spouses get the ATD benefit. Sounds cool, right?
So guys, you might say that me and my family fights a lot. Well, who doesn't? But guys, a family that sits together and plans their finances, it can lead to a lot of optimized financial planning. And it's also said that a family that prays together stays together. But I would say that a family that plans their finances together also stay together.
So guys, stop your dumb sibling fights like brother not giving gifts, sister bullying, and save some money and you will thank me later. Now go hit that like button, subscribe button and the bell icon, and we will see you in the next one.
See you guys.